Of course, wanting to retire and having the means to, two completely different stories. Speaking of, the time has come to look ahead at what will hopefully be a post-pandemic 2022 for the most part. So let's talk about your financial health. And once again, we're bringing in the president of Heritage LLC, Paul Schatz. Good morning, sir. How are you?
Good morning, my friend. Great to see you again.
Yes, good to talk to you again for the second time in just a couple of weeks here. All right, let's talk about how strong 2021 was for the overall economy and how you think 2022 is shaping up. Any big themes here?
So 2021 was, except for COVID, which is a big except, was a relatively quiet year. The economy was strong, except for the summer where Delta really hit it. But it was a good year economically. It was a super good year in the financial markets. If you had anything that had a risk-on characteristic to it, you made decent money. Bond investors weren't really rewarded. My two themes going forward for 2022, two words are easy. One is patience, and two is quality.
Why patience?
I don't think 2022 is going to be the rip-roaring year like 2021, 2020, and 2019 were for equity investors. We had the wind at our back, except for that 5-week COVID period in 2020 March. Really, the wind's been at our back with the Fed, 19, 20, and 21. The wind has and will continue to shift in 2022. Interest rates are going up. That's number one. We already know about inflation. That's number two. Yeah. So there's going to be a decent amount of headwinds. So for the average investor, don't expect double digits. It's going to be a much more modest year, possibly a small loss to a very modest gain for the stock market.
And I want to ask you about the economy as a whole, but I'm not quite sure how to do it because I feel like when I try to read and absorb what people are saying, they feel like there's been more of a decoupling between sort of the major indications on how the economy is doing as a whole in large terms versus how individual people and families are dealing with this, especially if they don't have a lot of money in the markets and they're dealing with sort of wage stagnation. So how do you sort of reconcile the two? How's the economy working for the average investor and the average person who's maybe not investing?
Well, clearly, Tim, the more assets and the more income you've had going into the pandemic, the better you've done. That wasn't designed that way. That's just how it all shook out. However, you brought up a great point about wages. Right now, and really for the past year to 18 months, wages are growing faster than any time in the last couple of decades. So finally, wages are going up. But I'll use a word of caution. We want wages to go up because that brings everybody up. It broadens it out and brings everybody up. The problem is when wages rise too fast, the labor market gets tight, meaning that there's a lot more people who don't want a job than want a job, and that forces wages and the competition for jobs goes down significantly. That is a huge, huge input in inflation. You want it to be like Goldilocks, not too hot, not too cold. It was too cold for too long. So the economy, look, I say this, everyone with quotes around it has had money because of what the government's done since April of 2020. $2.5 trillion in excess savings. That's unheard of. That will get soaked up in 2022. It's going to be a good year economically. However, the acceleration in the economy, it's getting better and better, will wane, as well as corporate earnings. So it's not going to be as good as it's been, but it won't be bad. No recession.
And this is why you're saying patience. All right, so what should we be doing with 401ks and other retirement accounts? Just sort of holding firm, pumping money in, and playing the long game?
Well, listen, investing is always a marathon. It's never a sprint. That's number one. Most people know that. Most people aren't knuckleheads when it comes to that kind of stuff. But you got to temper your expectations. I think the key pivot is you pivot away from what was working, which was stuff that didn't have a lot of earnings and was super expensive. Pivot into things that have quality. I think unlike 2021, bonds are going to be a decent investment in 2022. Not sexy, not exciting, but they should crank out low to mid single digit returns, which could match stocks, but with a lot lower risk. The key is quality. When it comes to buying mutual funds and ETFs and stocks, traffic in the stuff that makes money, pays dividends, and is getting better and better. Kind of stay away from the stuff that may have been world beaters in 2020 and 2021. So boring things like the Procter & Gamble and Colgate, which you wouldn't buy in your 401k, but that'd be consumer staples.
Right.
That'd be the S&P 500. That'd be large and mega cap stocks.
We ran out of time. Next time you come on, I want to ask you about the things on the exact opposite of the volatility spectrum from bonds like Bitcoin, cryptocurrencies. We'll get to that later on. But Paul Schatz.
You got it. I'll see you soon. Thanks again.
Thank you so much. Paul Schatz from Heritage Capital LLC.